Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming out and checking out the pre-market show webinar. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Demetrious, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, like all our webinars, are for informational purposes only concerning Market Chameleon tools and products. With that, good Monday morning, D, or Tuesday
Good,
morning. Sorry about that.
good morning, Will. How are you?
Good.
Yeah, good morning, everyone. I'm going to share my screen. And today we're going to cover our covered call screener. So, this is a strategy a lot of people use. They own stock and then they will sell calls. One for one against the stock to try to collect premium, to generate more income for using that strategy. And well, first let me just show you how to get to this covered call screener. And it's under screeners over here at the top. If you go to the right, single leg strategies, covered calls, you click on that and you will get to this page. And this page, it's a screener to try to narrow down potential candidates to do covered call strategies on. And you could see down here that you have many different potential candidates there and with different analytics. And then you have filters above here to continue to narrow down those potential opportunities. We also have different tabs with other analytics. And we're going to cover today this summary page and some of the insights and analytics that could help you narrow down those candidates. Now, one of the questions that sometimes comes through in our emails regarding covered calls is if you could run a backtest strategy to see how well this covered call strategy performed. Because if you're going to do, if you do a strategy and you're curious about, picking a strike, an expiration, and you're curious to see historically, how did this strategy actually perform? Was it profitable? Was it unprofitable? How frequently did it result in a profit? Because when you do a covered call strategy, well, if you pick an expiration, that option will expire, and then eventually you don't have a covered call strategy. Either the stock gets called away or the option expires worthless. You just still own the stock, and then you would have to do that strategy again. So when you're looking at that back test, you could look at potential covered call strategies like over here. When we end up on this particular screener, we do have a default setting here to an expiration. So this one goes to the next monthly expiration, but you could drop down this menu and pick a particular expiration or pick multiple expirations given a date range of when these options will expire, like here between 30 and 60 days, next 30 days, and so forth. But let's just, for our example, stay on the December 20th expiration. And when we come down here, let's go from left to right to look at what is in this summary table. And then we're going to discuss some of these analytics. And then we're going to look at filters to screen these analytics down further. And right now, I have these different columns. They are sorted by the highest market cap. So over here, I click market cap, and you could see Apple came up with different covered call strategies. Keep in mind, you have different strikes, so you could make a covered call strategy of at the money and out of the money and in the money strike. So that's why we have all these different, as you can see here, different strikes. So from left to right, this is the symbol, Apple. This is Apple's stock price, market cap. This is the expiration. And we have it all set right now to December 20th. So all these are December 20th expiration. We also give you the number of days left to the number of trading days left to the expiration. This is the strike, 225 strike. This is the call bid. So this particular cover call strategy is looking at if you executed the strategy on the call bid, which would be that's the available price to sell at, right? That's the firm price that is displayed in the market that you could sell it at. Of course, you want to try to sell it for a better price in between the market or above the bid, but the analysis has to pick a price, so it looks at the bid. This tells us the delta of the call. So the more the strike is in the money, the higher the delta. If the stock is further out of the money, the lower the delta. It's the price sensitivity of the option for dollar move in the stock. And here we display the moneyness, which is the difference between the strike price and the spot price. So if it's in the money, then the strike will be below the stop, right? So over here, the stock is $239.59. Well, if we're looking at a $225 strike, that's 6% below the spot price. So it's like you're already 6% of it's the difference between where the stock is now and where the strike price is. If the strike is above, it'll be a positive. Here's a 6.4. So we're looking at 255 strike. Well, that's 6.4% away higher than the current price, 239.59. All right. Here we have some stats I'm going to go over quickly because I'm going to concentrate on the ones here at the end, the backtest results. But here it tells us the implied volatility rank of this option. So what it will do is look at historically options that were similar to this particular option based on days left to expiration and its moneyness. And then it looks at those options that are similar and takes the implied volatility of our observations and then ranks today's IV to historical. So this is saying that 11% of our historical observations, the implied volatility was below the current IV. That means 89% were above. So we're on the lower end right now. Okay. And this is looking at similar options, not like an IV 30, but it's trying to match up a option again that has same days left to expiration and the same distance away. The strike is same distance away from the spot price. You're not going to get it exact, so it looks at ones that are the closest. So what this means here, you have a downside cushion because it's in the money, 6.1%, plus you got some premium in there. So if you're looking at a break even, you have a 6.5% cushion. I mean, if the stock goes down 6.5% and the options expire worthless, well, because you lose on a stock, you made up that amount in the option. So that's your break evens down 6.5%. So you got a downside cushion 6.5%. The amount of premium that you're collecting above parity. So this is extra premium, time premium is 0.4%. So you could see that there's not a lot of time premium because it's in the money, right? Out of 15, it's $15.60 in total premium, but you could see that it's already in the money, right? The stock's, let's say 240, and this is 225. So you can see that it's already in the money by like $15 and 40 cents or whatever this is. So not a lot of time premium in it. And this tells us, well, if the stock is at exactly the same price at expiration, okay, that at expiration, this stock price is $239.59. Well, then what is our return on the money at risk? That's 0.5%. Okay, so that's what this is. So now let's get to these backtest results. And the question sometimes will maybe, well, which strikes tended to, because I got all these different strikes on December 20th. I got 225 strike, 237, 255, 242, 220. All these strikes are different, and some of them are in the money that offer bigger cushions. Some of them are at the money, like right around 240. Like here's a 242. We could look at by the delta, right? The closer this is to 50, here's one at 240, right? The closer it is to the at the money, closer it is to 50 delta, and you could see it offers more time premium. So you have all these different strikes, and we have strikes that are above. Here's a 252.5. This is only a 10 delta, but it's 5% above, which means that if the stock rises 2 or 3%, you'll make on the stock, and the option will be worthless. You also collect the premium, but you only get 0.2% over here. Well, given all these scenarios, well, your one question could be, well, historically, which, if we looked at these different strikes and the different distances from the spot price with 14 days to go, did these strategies tend to, over a long period of time, like if we took a bunch of observations, right, not just one, but over a long period of time, was this strategy profitable? And if it was profitable, what was the average return? And if it was profitable, how often was it profitable? Was it profitable 1 out of 10 times, 2 out of 10 times, 5 out of 10, 8 out of 10, right? How frequently was it? And we might want to compare it. Was it even worth doing? Or would have I been better off just doing the stock alone, right? So if every 14 days, if instead of doing a buy right, what if I waited 14 days, bought the stock, wherever it was, at the end of 14 days, I would reset the notional. Let's say every 14 days, I just wanted to make sure that I don't have more than $1,000 at risk. Well, if the stock goes up and you made a profit, you would have to sell some stock to get back to $1,000 in notional. If the stock went down, well, you lost, but you won $1,000 at risk, so you'd have to buy more stock. So similar, like you're resetting a covered call strategy, because every time a covered call expires, you have to reset it. Right? You're done. Now you got to do it over again. So if I did that, would I have been better off just doing the stock alone? Does it even make sense to do a covered call strategy? Or would it maybe just doing the stock alone, right? Just have some kind of reasonable notional value that you're comfortable with every 14 days, and just do that over and over. So those are the questions we may be asking. And of course, we could take one at a time and try to go and run that analysis. But that will take you forever because we have over, 14,000 different covered call strategies just for December 20th alone in this screen. So to do that by hand would be, impossible to do. And you would have to go collect the data first, line it up, find similar options, find ones with 14 days to expiration. You account for if there's earnings, if there are no earnings. You have to go and do all that. So to make it easier, we have this program, this software to do it for us, give us the results right on the screener, and allow us to screen by those results. Okay, so let's see what this number one item is at the top, right? If we go from the first one. So we go all the way across, and it found us similar situations in Apple. Went all the way, all our data, and said, okay, we found 206 different observations historically that were similar situation. And then we looked at the starting point, so 14 days to go, right? With an option that's, let's say 91 delta. And we said if we did that strategy and then held that strategy to maturity, to expiration, what was the result? Profitable, non-profitable, how much? And then look at all of the results and give me, run statistics on. So here's what this is saying, that 96.6% of those historical observations, we have 206 of them, resulted in the strategy making a profit at expiration. Okay, so 96.6% of those resulted in a profit. That's the covered call win rate. Again, this is just for this top line item. So what was the average return for a 14-day hold period? Right? Well, if I risk this much, on average, I'm going to lose some. Obviously, there's some losses in there. There's some gains, but they're going to vary. Some are going to be more, some are going to be less. So on average, show me what that strategy returned, right? So this is saying at the end of 14 days, on average, it was 0.3%, which, think about it, it doesn't seem high, but that's not an annual return. That is a 14 trading day period. Okay, 0.3%. So if you add this up over the course of a year, it'll add up to much more. All right. So, but you still have to look at it, is it even worth it? You could compare that to the tax-free bond. So that's the covered call strategy. But let's look at the stock only. What if we took exactly those same 206 observations and we said we bought the stock at the start and sold the stock at expiration, and then did that over and over again, but using the same amount at risk? Okay, so after 14 days, whatever it is, we made our lot. Let's say we risked $1,000 worth of stock. That's what so whatever $1,000 worth of notionals, if the stock is higher, you buy less stock. If the stock is lower, you get to buy more stock. If we did that same strategy, but did not do the calls, we ignored the calls and we just did the stock, what how frequently did that result in a profit? And what was the average profit? So here we go. So you could see here that this resulted in a profit 55.3% of the time. What does that mean? That, well, from start to finish, the stock increased 55% of the time, right? 45% of the time it was lower, you would have lost. 55% was high. But when the stock goes up and it goes down, it doesn't mean that it always goes up by the same amount and down by the same amount. It could go up by a lot more or down by a lot more. So your returns, they vary. It's not always like it's either up or down 1%. It's not like that. It could be up any amount or down any amount. So even if it tends to go up, does it go up by more than it goes down on average? So let's take the average of all those returns. Okay, so we accept that there's going to be a larger amount of losses, which makes sense because there is no downside cushion. Once you buy a stock, if it goes down, you lose, right? You didn't sell a call to offset it. So once it goes down, you lose. Even if it goes down by a penny, you lost, all right? Because then you got to sell it for penny loss. Goes down by a dollar, you lost. You have to sell it for dollar loss. So there's no more cushion to the downside, but at the same time, you're not capped to the upside. On a covered call, you're capped, right? If the stock keeps going above the strike, well, you're going to get called away at the strike. You don't get to do a covered call and the stock goes to the moon. Well, too bad, you sold a call against it. It gets taken away. So your potential upside, on the upside, your potential return is higher without a covered call if it keeps going through that strike. So what were the average returns on the stock? It's important to know because there's a trade-off here, right? There is a trade-off when you sell a covered call, and that's you will forego potential profits if the stock goes much higher than the strike.
ED?
Yeah.
We had a question. Obviously, there's a delay between YouTube and you, so I don't know when it was mentioned. But Stefan's asking, is time premium is the same as extrinsic value converted to percent?
Yeah, you could think of it that way. It's exactly. You take away whatever the intrinsic value is, the difference between where the stock price is and when it's in the money, and take the time premium and what divide the time premium by the stock price. So real quick, so now we have.
And actually, someone just popped in, and Rob was nice enough to ask him, but he's asking, I missed the start. How do I get to the screener again? Could you just show that real quick?
Yeah, so up top, go to screeners, and then over here, single leg strategies, covered calls.
Perfect.
Yep. All right, so now what we do is we see that the stock on the same strategy, if we just removed the calls, right? That's what we did. We just removed the writing the call part. The same strategy on average returned 1.1%, much higher, right? So this is this is telling us that the covered call strategy, while it did increase the percentage of times that it was profitable, because you had that downside cushion, obviously. So so when it was down even a little bit or stayed the same, it increased your frequency of profits, which makes sense. But the average return, if we took all these observations, was much greater, like almost 4 times greater without the covered call in this particular instance, when we're talking about a 91 delta, right? You're talking about you know, a 1.1% on average return versus 0.3, even though we had to incur historically more losses, right? You get more losses. When I say more losses, more times or more frequent periods where you had to incur a loss, but this strategy returned more money. You would have like this strategy over here, you would have ended up with more money at the end. Okay, even though there are more frequent losses than this strategy over here. That's what this means. Okay, so in 14 days, on average, you would have made 1.1% instead of 0.3%. So hopefully everybody understands that, that even though, yes, I had to, bankroll and incur more frequent times where, I had to give money back, but on average, I brought more money back. Yeah. Okay. Because some of those gains could have been very high. And if we wanted to go and look at that, we could load this analysis, click load, and then this will go and retrieve, okay? This will retrieve all the different observations. So we could take a look at it over here. So you could see here all 200. So this is showing us the actual, here's the call strike. This is November 8th. Okay, it started 14 days to go. It was a 94 delta. This was the market before. This was the stock before. Then at the end, November 29th expiration. This is where the stock was, 237.51. This is what the strategy returned, 0.3%. This is what the stock only returned, 4.6. So you have all the data here, to support this analysis. Okay. So this is all right directly in your screener. We could even go and screen these results, where we wanted to see, well, show me where the covered call average return, right, was, I don't know, more than, let's see if there's anything over 2%. So here's over 2%, right, covered call strategy returns. But let's see if we could find where, let me see here. Let's see where the covered call actually outperformed the stock. So let's say the covered call, the strategy, covered call strategy returned more than the stock. And now you could see here, these are where the covered call returned a little bit more than this. See 2.2 versus 2.1, 3% versus 2.9. So you could do all this quickly from this screener. So I'm going to stop right there, Will. We're right up at the end.
Yeah, that was an awesome job, D. Thank you very much. Thanks for the questions, chameleons, as you came through. Great job as always. Another excellent morning webinar on covered calls. Awesome job, buddy.
Thanks everyone for joining. Stay safe out there and have a great trading day.